Welcome back to the Armchair Trader podcast. And while we do talk a lot about trading on our website, we haven't really gone into a lot of technical detail about the subject here on the podcast. We've visited the topic of technical analysis previously, but we've sadly neglected the nuts and bolts of actual trading. So we're going to rectify that issue today, and we've got John Woolfitt, who's the Director of Trading at Atlantic Capital Markets, on the podcast this morning, and we're going to have a chat to him about that. So welcome to the podcast, John.
Thanks for having me, Stuart.
So really what we wanted to talk to you about today was just more about good practice than anything else, and it's something that we saw a lot of where people just were making some basic errors that ended up costing them a lot of money, and it wasn't to do necessarily with the market they were trading or their strategy. It was more down to just not really understanding some of the key concepts of trading. So I thought it'd be a good idea to get you on the show today. Really, as a first point, could you give us a bit more background on yourself and Atlantic Capital Markets?
I've actually been in the market since 2004. I'm a chartered member of the CISI, and in fact here at Atlantic Capital Markets the full team of advisors are all chartered with the CISI. We're a multi-asset brokerage. We're one of the very few privately owned multi-asset brokerages in the UK, which enables us to offer a boutique service. All clients are assigned their own personal advisor. The advisor is someone that they can really build a relationship with. And we've been acknowledged in the industry through several different awards, not only for the advisory service, but also with the trades that we recommend.
And a lot of people may already be familiar with execution-only trading, where you're left to it. Can you just give us a quick summary of what is involved with advisory trading? What is that additional service?
All clients have a personally assigned advisor. This is someone who they can discuss their ideas with as well as our own. I mean, our service is very unique in the fact that if we see an idea that we like, we tend to send a text message to the client to give them the chance to take a look into it first. If they like it, they can call us to discuss. If they don't, they simply put the phone back in the pocket and get on with their day. But it's not just about what we see, it's as much if not more about what the client's looking at and their own ideas and their relationship with the advisor that they build, whether it's a buy or a sell, or sometimes it can simply come down to the third option when it is best to really just not get involved. And it's about having that person to call. The markets can sometimes be a lonely place, and especially if things haven't quite gone to plan. So having somebody that you can call to discuss, to get a second opinion and a view, it's a key tool and something that everyone should have in their armoury. Whether you decide that the opinion that you've been given is something that you agree with, then well, that's entirely up to you. But at least it's that person to call.
And this sort of brings us on to our main topic, which is good trading practice. And I know you guys, because you've got that additional hands-on service, you can help new traders avoid some of the common mistakes. But can you give us a quick sort of overview of what some of the common mistakes are that an early stage trader, someone who's literally only been at it for a few weeks or maybe a few months, is likely to make?
Yeah, sure. So, a lot of it sort of falls into discipline and quite frankly, it's not a case of not doing the right thing. It's probably not knowing the right thing. So, the main things that you can see is, the appropriate position sizing, for instance, taking positions that are clearly oversized for your account. This always, is something that you can see when people are new to the market. Lack of risk management, for instance, not having a stop loss order to cap the risk. Sometimes this can come from overconfidence in a person's own trading ideas. A big factor at the moment is a lot of online hype around stocks without really doing the proper research. And like I said, there's a lot of noise on this, and this presents a problem on two sides. Firstly, it's hype and goes deadly quiet, and the risk on that kind of trading is also huge in comparison. I think also as well, unreal expectations and profit targets. It's always worth keeping everything in order and remembering that someone like Warren Buffett, who we do all consider to be one of the greatest investors of all time. I mean, his average annual returns have been around 20% a year. So it's understanding that if you're going to try and target more than that in a year, then the risk that you're taking, basically. And also as well, just remembering that all good traders take losses. It is part and parcel of trading. And the key to this, again, is keeping your trades organised and disciplined, taking a small capped loss, and that's far better than staring at big red blots of ink on screen.
And you just touched on that briefly, but keeping track of what you've already done, and being able to analyze the trades you've made and how they performed is on the topic of record keeping. Is that an important part of the trader's arsenal?
Absolutely. Whatever you do in life, people tend to keep a record or score, whether it be anything sporting, anything personal, whether that's a weekly, a monthly, or yearly. And this should certainly happen when you're trading as well. Then also as well to keep those records and to keep everything in check. Really, you've got to be looking at keeping your losses capped and really trying to be in a situation where it's never bigger than your biggest gains. I mean, this does then fundamentally undermine you if you don't trade with the risk management in place. So at the end of any period, whether it be day, month, week, then you can have a real sense of your win-loss ratio, the average trade size, and your average gain and loss. I mean, like I said, you don't really play any other sport and wonder what your score was at the end of the game. It's tracked throughout and kept as a record to be analysed afterwards. And this has got to be the same with trading. And again, it's also down to also just keeping an eye on the news flows surrounding your trades as well, because this can have an impact on the outcome. And then this will also be crucial to your success.
It's also, I guess, if things are going wrong. I mean, I've spoken to really experienced traders in the past, and they can get into a rut where suddenly they feel like they're consistently losing and they can't work out what it is. And then when they go and talk to external advisors like trading coaches and people like that, one of the first things they're going to ask for is, let's have a look at your trading record. Let's look at when you put the trades on, when you took them off, how they did. I guess that's really an important insight to your psychology as a trader.
Absolutely. It's looking at what we've done is really how you can assess if a certain strategy isn't working. If it's not working, then ask yourself why. Look at what you're doing. Are you in a certain sector that's just simply too aggressive? Are you trading in a trade size that's not appropriate and therefore causing you concerns? And I think it's always although it's always with hindsight, but it's the stock market and that's the only way you can truly analyze your performance. You've got to be mindful of not only the records that you're keeping, but what these actually tell you about your trading. For instance, if you're trying to trade a commodity over and over and over again and it's not working, then there's something wrong there. The analysis, the systems that you're using, and this again, it's always goes back to just keeping that record, understanding what you're doing. If it's working, don't change it. If it's not, criticize yourself. Don't be afraid to do that either. Some of the most frustrating times that I'll have is when I'm looking back and analysing what's I've maybe done or what I've looked at and how it hasn't worked, and I'm quite happy to openly criticise myself, because from that you can understand more and you can grow.
I wanted to ask you about position sizing, because that's something that sometimes gets neglected in some of the basic trading 101 guides, and indeed even sort of more experienced traders probably spend less time thinking about position sizing than they should be, because this is actually quite, I personally think, quite an essential piece of the overall puzzle. Can you give us an overview of position sizing and what the best practice is there?
Yeah, absolutely. I mean, correct position sizing in my mind is one of the most critical factors. And it comes down to really trading a size that's appropriate for the account. And this then translates into how you feel. You know, if your trading positions that are simply too big, you're going to feel the pressure if it goes in the wrong direction. It also adds to the fact that this could mean that you make a decision that is rash, not based upon what's going on with the share or the market you're in, but because the size of the position is simply too big. You know, really, you want to be sort of trading in a fashion that means that you can go around your daily business without feeling the need to keep checking in every 5 minutes. I mean, it's human nature as well to feel that on certain high conviction trades, you want to do more. However, this can have a real negative effect on the longer term, especially if that trade doesn't go to plan. So what I can see, you know, does trip people up is incorrect or infrequent trade sizes, because also infrequency on your trade sizes can have a negative effect, because you may well find yourself losing on bigger trades and winning on smaller ones, and this just means you've got to run twice as fast to stay still. So there's a bit of a rule, bit of guidance. You know, with leverage trading especially, you really don't want any singular exposure to a stock accounting for more than 20% margin on the account. You can then account for this further if you use the stop loss and capped your loss at 5%. Now there's old saying that I was always party to from the early days, is that winners add to winners and losers add to losers. And what I mean by that is, if you have got a great trade and it looks good and you've already done one position at the appropriate size, you can always lock in a stop loss to secure some profit and then buy some more. So effectively you can increase your position size to one stock without increasing your risk. And the benefit for that is also the fact that you've got that sort of confirmation from the market that the trade's actually going the right way, because your first position you've locked in some profit and allowing it to run. But I think that the easiest version to this rule is, if you are thinking about your positions in your day-to-day life, or you worry about it last thing at night or first thing in the morning, your position's too big. It's as simple as that. And I think it's something that, you know, a lot of people need to just get in order, because if you get that in order, it takes a lot of the other pressure off, and therefore you can have a much more successful trading journey.
That is a very good point, actually. If you're worried about a position, then it's definitely too big, and it's time to at least trim it. Which I guess brings me on to the next issue, which is running profits and cutting losses, which is again quite an important piece of overall risk management that a lot of people will neglect. Can you give us a bit more color around that? What that looks like in practice, and why it's good practice?
Yeah, sure. I mean, this is one of those things that is the easiest thing to say and possibly one of the hardest things to do. You know, it's a case of run your profits, make the most of it, and cut your losses early. And, you know, it goes down to a little bit similar to, you know, we all know that you should eat less and exercise more if you'd like to lose weight. Spectacularly easy for us all to say, but very hard to put into practice. So all I can really say is, at some point you will break this rule. Be self-aware when you break this rule, and be wary of your mental accounting on why you've done it. You know, you'll be saying to yourself, this time it's different because, and you'll attempt to give yourself logic or a logical argument in your head that excuses the breaking of this very simple rule. So, you know, a technique to help counter this is to decide that when you place a position, when you will be wrong. And it's accepting that you will be wrong. You know, if it gets to this price, maybe you're looking at it as a trade that's coming up from support, and if that support level is then breached, it's accepting in yourself that you've got this one wrong and you need to walk away. Sometimes this can also come around if there is a fundamental change in the news. So the best thing, again, and it comes back to using, or something we're going to discuss, using a stop loss. Point out your level that you feel the trade is no longer the trade from the start. Lock a stop loss there, so if it goes wrong. And then when it comes to the upside and they're running into a decent profit, again, you know, there's so much emphasis put on a stop loss order that triggers losses, but they're actually a very strong tool for actually securing profit as well. So really what you want to try to do is, as the trade goes in the right direction, just keep pushing the stop along to keep locking in and allowing it to run.
Which does bring us very neatly on to stop losses. I mean, I'm a big fan of stop losses myself, and I've used trailing stop losses consistently, particularly in certainly in forex trades where markets can be, I feel, more unpredictable. Can you give us some idea of what effective use of stop losses looks like, and also, you know, there is ineffective or expensive use of stop losses as well?
Yeah, I mean, for me, they're a critical tool with trading. I mean, with the placing of any position, there'll be a target expectation to the upside, and it's human nature, in my opinion, to focus more on this than the downside. However, there's also a level, as mentioned, that will mean the trade is no longer the trade you initially thought it was. And this is really where the use of a stop loss order becomes critical to your success. So at the outset of any trade, one of the first things to do is really consider what you see as reward and then what you are looking to risk. This is really the key structure to any trade, because obviously if you're risking more than you think you're going to make, it's not even a trade in the first place. You should be walking well away. But at the outset of any trade, is look for that stop loss level, perhaps on a technical basis below a line of support, or indeed below one of the longer term moving averages, and then using that and sticking to it. And you know, I always know, you know, human nature. No one likes taking losses or triggering stop loss orders. As human beings, we look to avoid pain at all cost. But the reality is they are a safety net. And the reason for this is it means that if the share price has dropped, you can come away from it, you can reevaluate your position, you can perhaps look for a lower entry, or indeed just walk away entirely. And that for me is a crucial part of moving yourself forward. As I mentioned before, there's always a lot of view on the stop loss being a negative, in the fact that it's actually, in fact, I had someone say to me once, it's not a stop loss order, it's a start loss order, because that's where your losses start. But it's clearly a case of it's not gone to plan, accepting it's not gone to plan, and then moving on. And as I said, you know, they are also a fundamental tool in enabling you to get the most out of a winning trade. If your position's in profit, use a stop loss to lock in some profit, allow the trade to continue. So I see these used very successfully, because when it comes down to it, timing an exit can be very tricky, but using a stop loss to lock in your profit as long as you go gives you the comfort of knowing you're going in the right direction. I always feel they're a bit like a parachute, really, in the fact that it's better to have it and not need it than need it and not have it.
Very wise words. Over the years, I've probably interviewed, I would say, probably over 500 fund managers about our next topic, which is news awareness. And I've spoken to asset managers who have ideas that are opposite extremes, fund managers who are almost entirely news driven in their strategy, and at the other end, others who prefer to sit on a rocky atoll somewhere and not actually look at the news flow at all, because they're completely focused on what the actual market is doing, but not what's influencing it. So what's your view on news awareness for the trader? I mean, how much attention should they be paying to it?
Yeah, well, I think the active trader's got to be aware of the news flow, especially news that moves market, even if it's short term. I think you know, especially if it's a trading announcement, or if it's been upgraded or downgraded, these certainly do have an impact on the shorter term, and it will then be really, for me, the view on news is based upon your time frame for your trades. If you're sort of mid to long term, you may well not see it as quite as rigid as the short term trader, but the successful trader will always just look behind that simple headline and realise that once the news is in the public, it's almost immediately priced in. And there is certain strategies that I see to surf the news, for instance. So you might see a headline that says, for instance, buy Tesla when Goldman Sachs has upgraded the stocks. And the active trader could well move on this, but the real buying, you know, a lot of the time has already taken place before these announcements are made. So it does create a second wave of what we would call headline-based trading, where you can be seeing profitable jumps on that short-term news, but you've got to be aware that after the news has been digested, it no longer has the impetus to the market that it did on the first release. So you've always got to be critically aware of the news, especially the news flows surrounding your positions. And equally, this again, it goes back to re-evaluating what you're doing. If you're in a position and there's some negative news, you have to re-evaluate whether that trade is still the trade that you initially set out for. You know, this could be anything from bid rumours. You know, you might be in a stock because you feel they're going to get bid for, and then you see a bit of news that this isn't going to happen anymore. So therefore, that position is not the one that it was when you set out, and you must use this news flow to your advantage the best you can, really.
I want to ask you this, and you don't have to answer it if you don't want to. But talking about this, what's your view on the meme stocks that we saw earlier this year, and the tendency of many people to chase those prices, basically?
It's a tricky one to comment without feeling that I might offend certain listeners, so I certainly don't want to do that. For me personally, they have no place in a professional trader's life. They're interesting, and and the excitement's there, but I think a lot of these meme stocks, a lot of the hype, they seem to be fueled by chatter online. They seem to go in that favour and out of favour very quickly. You know, fortunately for us, our sort of advisors here at Atlantic have very strong personal relationships with our clients. So when it all started, we were getting a lot of calls. You know, is it something we should participate in? Isn't it? Our view was very clear. It's not a long-term sustainable strategy. You know, you could be making a great profit today and being wiped out tomorrow. Unfortunately, a lot of it circulated through social media as well. And what I did notice is everyone was happy to tell you about the winners in hindsight, but there was very few people holding their hands up and saying, well, I got AMC at 70 and it's now down to 30. So it was a very interesting sort of phase, but I don't know anyone that I look after of any serious wealth, or indeed, to be fair, of anywhere along the spectrum that saw it as a viable investment strategy.
Another common mistake is when you open your trading account for the first time, you'll be confronted with all these different markets, and it opens a whole new world of opportunity beyond equities trading. It can seem quite fascinating to see that there are commodities markets, forex markets. You can trade volatility, you can trade interest rates. I mean, there are some very big hedge funds that are active across all these markets. But one of the, well, actually, it is a common question when people start getting involved in trading is how many markets should they trade? Should they just be focusing on trading the FTSE, or how many markets can they really realistically keep track of? And can you end up trading too many?
I think you can. I think when it comes to the markets, especially in this day and age, there is a huge amount of instruments. Not only the FX, equities, commodities, but obviously now there's more exotics with cryptocurrencies, things like that. And I think a lot of these go through almost fads, if you like. There was a while back where lumber was the hot stock, the hot commodity, and everyone that was calling up saying, have you seen this run on lumber? And to be fair, it did have a huge run. But I think as a trader, as a professional trader, I think if you try to throw your net out that wide that you're looking at everything, you can actually end up tripping yourself up, because you're not only looking at different instruments, different commodities, you're then trying to analyse the news flow, understanding supply and demand, and I think when it comes down to it, we all can get sort of distracted, if you like, from your primary objective for trading. And what everybody's in trading for the same reason. They want the accounts to grow. So whilst you could hear an exciting story about something that you've never heard of that's happening somewhere else on the planet, it's always important to keep your discipline. So I always feel it's better to be focused on one area or one market. And I think I've even seen experience of this drill down even further. Some people that I speak to are only what they might say sector specialists. For instance, they might focus on the miners or the banks. For me, I like to focus on the FTSE, mainly because If I focus on the FTSE 100, there's 100 stocks there that I've been watching for the best part of 20 years. Some come and some go over time, but I can trust the pricing as well. I can trust the liquidity on these shares. I know they open at 8 a.m. in the morning and they close at 4:30 at night. So I can go home at 5 o'clock, leave the office comfortably knowing that there's going to be no drama that I come into in the morning. And that again, it goes back to almost the same sort of pressure that you might feel if you're trading bigger size positions. It's critical, in my opinion, if you're going to go the distance in trading, to be able to switch it off. And if you can't switch it off, then you can't get the right amount of sleep, and you end up spinning too many plates. So I tend to stick to the FTSE 100. I can trust the pricing, I can trust liquidity, I know when the market opens and I know when it closes. And okay, so the shares might not move as dramatically as some of the small caps or some of the commodities, but I'll use the CFD to create the profit rather than seeking out high impact movers. So I suppose it just comes down to, you could be the jack of all trades, but the other side of that one is you end up being the master of none. And it's hard enough if you're trading to keep focused on a small area, but it's the best way because you don't get distracted by background noise.
And as a corollary to that, do you sometimes find that traders have a tendency to leave trades on when they shouldn't, when they should really like they're going to go traveling and they think, oh, I think I can make some more money on this one. I'm not going to close it and go to cash. But then they're off in, I don't know, backpacking around Patagonia or something like that, and they've left their trades open basically. I mean, okay, they could have stop losses to protect them there, but what's your view on if you're going to be away from your desk for a few days? Is it possible to keep track of things on the mobile or
Yeah, I mean, trading technology in this day and age has come on incredibly so. But I think if you're in that sort of position, this is where a service like ourselves actually comes into play. You want to have the ability to live your life and do what you're doing, but still have someone that you can quickly call. We have clients all over the planet that are traveling here, there, and everywhere, and a call will come in the morning. How am I looking on this? I can't get to the laptop. Or indeed, if there's critical news flow that you need to be aware of. I myself, I would, if I knew I was going to be away from the markets and have no visibility, I would certainly make sure that any positions that are open have the appropriate stop loss in order. And equally, if I had a set target price for the exit, I would also make sure there's a limit to take the profit as well. And then at least I can have the comfort of knowing the best case scenario and the worst case. I think if you're in that situation and you've left your positions totally open, then you run the risk of a surprise. It could be the best one you've ever had, and it could well be the worst. Either way, when it comes to the stock market, surprises, they don't form part of a good investment strategy.
And so finally, I wanted to also ask you about position sizing when someone's going into a trade. A lot of people just assume, I mean, a good example would be someone they've got their trading capital, they chop it up into 10 pieces, and then they just go, okay, that's the size of the different trades I'm going to be putting on. But there's actually a little bit more involved than that, isn't it? What's your view on the best practice there?
Getting the exact right entry to a trade is near on impossible, and it can become an obsession for some, and it can end up causing you more harm than good or missing good trades. So when it comes down to it, for me, if you've done your research and you like a stock or a trade, then there's a general price range that you need to identify for entry. And I'd always say this comes down to, especially in trading, it's always better to be approximately right than exactly wrong. So one technique that's always good as well for those that are new to online trading is maybe splitting up the trade entry points. So let's say, for example, you followed the rules and you've decided that a position size of say 10,000 suits your portfolio. Then rather than try to do the whole 10,000 at one price, instead you look to build to the position over time. You might do £5,000 twice or 2,500 four times. And this, for me, it's great for newer traders because it has an extremely positive psychological benefit. If the price goes lower, then you're quite happy because you can build up your required amount at the lower average price. If the price suddenly has some news and falls right out of the sky, then you're risking on a small tranche to begin with. If it starts to lift, well, you're still happy as you're in. You've got some, it's going up in value. So there's almost a psychological win-win here. If it doesn't go immediately to plan, you can pick up the extra tranche. If it does, well, you're already in. And this works both for me. I've seen it work great for new traders, but also it's a practice that the experienced, more professional traders really use a lot. It's accepting that you're not calling the exact right price, but you want to build a position up around these levels. Now, there is an extreme word of warning on this, and I do want to make it clear. There's a big difference between this and simply just averaging your price. You know, I would say never average prices like this if it wasn't the explicit intention from the outset. Because what can happen there is you might have established that £10,000 is your suitable trade size, and you actually buy another 10,000 at a lower level. And so you are attempting to double down on what is essentially a losing position. And this can lead to huge losses. So I would say building into your positions is the right way, but this strategy should only be employed when you've followed the rules, you've calculated your correct position size, and then you've split that correct position size into various tranches from the outset.
Well, thank you very much indeed for that. That's been excellent, John, and I think that will provide traders with some excellent advice, especially if you're an early stage trader and still feeling your way in the market. Can you give us quickly just a little bit more on where people can find Atlantic Capital Markets if they're interested in having a further discussion with you?
Yeah, certainly. I mean, we're online, atlanticmarkets.co.uk, on Twitter, Atlantic_CM. We're on Facebook and Instagram. So we have a great online presence. We're a very friendly group of chaps. Like I said, all the advisors are chartered. We've all been in the markets for at least 15 years. You know, we're not here to tell you, but we're here to guide you and help you and give you the advice on how to trade. So we're all over online. You know, if anyone listening fancies a little bit of a chat about trading, and I think, you know, also as well, not just about trading. You know, there might be something in your long-term portfolio that could be giving you a bit of a headache. We've got the badges, we've been through the good times, we've been through the bad times, we know what works, we know what doesn't, so we're always happy to have a chat.
Fantastic. Well, thank you very much for coming on the podcast this morning, and thanks for giving us some of your insights. That's been excellent, John.
No problem, sir. It's been an absolute pleasure. Look forward to speaking to you again.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.